In my last video, I spoke about getting a car in Canada as a newcomer, and I had a lot of people reaching out to me in private asking about a few questions that they would love to get answers to. One of the things that kept coming up was, how does the interest payment work like? So in today's video, I want us to dive into how car loan interest work when it comes to at least getting a car through financing, and also understand how your interest payment will work out. It is important to understand your car loan interests if you are considering buying a car. So it is important to understand how the interest payment works out like, because that will help you to at least have tips on how you can make savings when it comes to your interest payments. So now let's say you've landed in Canada and you've decided to get a car. You've headed to one of these companies or dealerships and you decided that your best option is basically to finance a car. Let's look at the anatomy of your car loan that you might find yourself in. One thing that you need to be aware of is that there are three factors that will affect your car loan interest payment. And knowing the different components of your car loan will help you understand how your car loan interest actually will be calculated. That way, you know what actually is going into your payment calculation, so you will know which areas that you can at least make some savings when it comes to your car loan payments. The first component of your car loan is the principal. The principal is the full amount that you are borrowing to cover the car payment. This is minus any down payment that you decide to make towards the car. And this is actually the amount that you are borrowing before any interest is actually factored into the equation. The second component is the loan term. The loan term is actually the amount of time that you've agreed to pay off the total amount of money that you are borrowing on the car. And on the average, a loan term can be between 24 months to as high as up to 72 months. And I've seen some people get terms that go as high as up to even 84 months. Even though sometimes some people can negotiate terms that can be shorter or even longer than this particular average 24 to 72 months. The third component is the interest rate. The interest rate is the percentage that you agree to pay on the principal that you are borrowing from the lender. So basically, this is how much the person is prepared to charge you to at least lend that money to you to use to buy that particular car that you are looking to finance. Simply put, this is what most times they will call the cost of borrowing. And in most cases, the interest rate that you will get will depend on your credit history. That's your ability to be able to pay for monies that you have borrowed in the past. And there will be other factors that will come into play. In my case, when I was trying to buy a car, besides checking for credit history, they also asked whether I was currently employed, asked for employment letters to be able to do some amount of verification on my ability to at least pay. Because if you have money coming in, it will show that you have enough liquid money to be able to afford the monthly payment on a monthly basis. And sometimes the details of your loan can also affect your interest rate. Depending on what kind of terms you've agreed with the lender, that can either increase your interest rate or make it lower. And one other thing that I found out when I was trying to buy a car was also the fact that whether the car is new or old, that has also an effect on the interest rate that you will be offered. Generally speaking, a simple interest rate is your best bet because it allows you to pay off your interest at a faster rate, and most times you end up paying a lesser interest over the period. So now that we have an idea of the components that will influence your car loan interest calculation, let's take a typical look at how your car loan interest will be calculated. Car loan interest is calculated differently depending on the loan type that you have. There are two types of car loans with different impacts on your payments. We have the simple interest car loans. Then there's a pre-computed car loans. In most cases, a simple interest car loan is a more flexible option. With simple interest loans, your interest owed at every given time is based on your total outstanding principal that is owed at the time of payment. If you decide to pay more than you owe at a particular billing cycle, that will mean that the total amount that you owe will decrease, which will mean that in the long run, you are paying less interest on the amount because the total amount that you owe has actually gone down. However, with pre-computed car loan, your interest owed is actually calculated at the beginning of the loan period, and it doesn't change over the life of the loan. That means your actual interest that you need to pay on the loan is actually calculated upfront, and it will never change whether you decide to make payments beyond the amount that you are supposed to pay in a billing cycle or not. And with this, it makes it harder to pay off your loan at a faster rate, because whether you decide to make huge payments or not, you still have to pay for the full amount that is agreed at the time of signing on the loan. This is why I said earlier that generally speaking, the simple interest loan option is the best option to go with, because it gives you a lot of room for flexibility when it comes to payments as compared to the pre-computed option, which you actually have the loan agreed beforehand with the interest rates, and that will never change whether you decide to make big payments or not. Now let's look at some factors that can actually impact your interest rates if you decide to go and get a car loan. There are a number of factors that can actually determine the kind of interest you get on your car loan. Getting to know these factors will help you to make a right decision for yourself when you decide to go in for a car loan. Number one is your credit score. Your credit score actually helps lenders to gauge your ability to make payments if they decide to loan you money. Your credit score actually helps lenders to gauge your ability to make your regular payments if they decided to go ahead to loan you the money. So if you have a good credit score, there is a high chance that your interest rate will end up being lower. This is why I always advise that when you come in, it is important to start building your credit history as quickly as possible, so that you can let lenders know that you have the ability to pay off money if they loan it to you. Number two is your down payment. Your down payment is actually the bulk sum that you pay upfront towards the car when you decide to make a purchase. And the down payment can actually affect the kind of interest rate that you are offered when you decide to buy that particular car. Your lenders will actually factor it into your loan to value ratio, which is the amount you borrow versus the value of the car. So the more you put down, the higher the chances of you getting a lower interest rate. Number three is the loan term. Your loan term is actually the total amount of time that you agree on to pay off the total amount of money that they are lending to you. And generally speaking, the longer your loan term, the higher your chances of you getting a higher interest rate on your car loan. Longer loan terms may be seen by lenders as very risky. That is why they normally give you a higher interest rate. Now let's look at some tips to help you make some savings on your car loan. If you have a simple interest car loan with no prepayment penalties, then these are the steps that I would suggest you go with to help you pay off your loan faster and make some savings when it comes to your interest rate. Number one is pay extra when you have money. So if you get bonus at work or come into any sum of money one way or the other, you can put it towards your car payment as a lump sum, which will allow you to at least reduce the principal, and that will allow you in the long run to reduce the total amount of interest that you are paying on that particular car loan. So let's say your car loan payment, you are supposed to make a payment of $350 every month, and you come into, let's say, a bonus at work, $5,000. What you can do is now you put that money towards the payment of your car, and what that might end up doing for you is either it will reduce the total amount of months that you have to pay off for the car, or it will reduce the total amount that you have to pay on a monthly basis in the long run, which in the long run you end up saving, because whether you are reducing the principal or you are reducing the loan term, you are still reducing how much you are paying in the long run. My second advice is make sure you run up your regular payments. This may not seem like a lot, but trust me, it can help you make some savings in the long run. What I mean is, so let's say your car loan payment, you're on a bi-weekly payment, and you are supposed to pay, let's say, $174 on a bi-weekly basis. Instead of paying just $174 bi-weekly, if you can afford it, you can choose to run it up to, let's say, $200 bi-weekly. What that ends up doing is that extra that you are paying is going ahead to reduce your principal in the long run, which will help you pay off your car at a faster rate and reduce the amount of interest that you have to pay in the long run. The third one, and that's the most important one, is to make your payments more frequent. With this one, what I mean here is, if you have the option of making a bi-weekly payment compared to a monthly payment, you can go ahead and choose a bi-weekly payment. The funny thing is, if you are doing a bi-weekly payment, you will end up making about 23 payments in a particular calendar year. But if you decide to go with a monthly payment, you are actually making 12 different payments in that particular calendar year. And those 23 different payments, if you add it in total, you realize that in a particular calendar year, you would have made more payments than if you had just gone ahead to make a monthly payment, because there are more bi-weeklies in a year than there are months in a year. Before I leave, my advice to you will be, a car loan is a very big responsibility. So before you make a decision to sign one, make sure you have a full understanding of everything that you are signing on to. If you don't have an understanding of it, make sure you consult with somebody who has an understanding, or that person can accompany you when you go ahead to sign yours, so that they can help you to review the documents before you put pen to paper to sign that particular agreement. And by understanding the factors that go into your car loan, you can make a conscious decision to at least help you save on the interest, because every money saved in your pocket can go a long way to at least make your life better. This was my piece that I felt I should share with you, at least to educate you when it comes to at least car loan payment. If you got value out of this video, kindly share with your family and friends so that they can all learn. And if you haven't subscribed yet, kindly subscribe to join this family so that we can keep growing and learn together. If you have any questions, feel free to leave them in the comment section so that we can all learn together. Until the next video, cheers.